Welcome to Understanding Credit Scores, choosing the right lending partner for business growth. My name is Andrew Lockman. I'm an account executive with FTL Finance. I work with contractors and equipment suppliers across the country to help stress the importance and ease of offering financing.
And I'm Kelsi Cooper. I'm the sales manager. I work with the team of account executives to support those efforts.
The consumer financing industry is constantly changing, and lenders use different tools to determine who to lend money to. This webinar is designed to pull back the curtain, give you a greater understanding of how lenders operate so you can make a sound decision on the right lending partner to grow your business. We've all checked our credit score at some point, and you probably noticed the scores are not consistent across the different credit reporting agencies. We're going to explain why this happens and how it impacts your business. Basically, there are two different scoring models, FICO and VantageScore. And there are three different credit reporting bureaus, Experian, TransUnion, and Equifax. Think of FICO and VantageScore like a complex math equation, and the credit reporting bureaus as data collectors using the data in these math equations. Credit scores are determined by Equifax, TransUnion, and Experian. The credit reporting bureaus receive data from lenders. This data includes information like on-time or late payments, balances, credit limits, inquiries, things like that. The reporting bureaus then plug that data into the FICO or VantageScore fancy math equation, and you get a credit score. The reason your credit score isn't consistent is because Equifax, Experian, and TransUnion use different data to determine those scores, and lenders may only report to one or two of the credit bureaus, which also alters the data used to determine the score. Where the score falls in the scoring tier is an indication of lending risk. I'm sure you've all seen these graphs before, but these categories are broken down into super prime, prime, near prime, subprime, and deep subprime. FICO and VantageScore both use the same score range of 300 to 850, but the scores included in each tier are going to be different with each company. VantageScore is a little bit more forgiving, with 750 as the threshold for excellent or super prime credit, compared to FICO, which is set at 800. The other scoring tiers reflect a similar shift. FICO's scoring model was introduced in 1989, which makes it the oldest scoring model still in use today. FICO scoring models use a snapshot of your credit at the time of inquiry. Large banks typically use FICO scoring models and those scoring tiers we looked at, which benefit those with a long credit history. VantageScore, on the other hand, wasn't introduced until 2006 as a way to compete with FICO scores. It was actually created by the three credit bureaus, Experian, TransUnion, and Equifax, and it uses a broader set of data. VantageScore can be used for anyone, but it is going to be especially useful for those people with minimal credit histories or some pretty thin credit profiles who may be considered credit invisible by some of the FICO scoring models. VantageScore looks at trends from the past 2 years to determine how debt is managed and how payments are made, compared to the snapshot that FICO uses.
Here you can see the differences between the two scoring models. FICO is more restrictive, and it tends to benefit those with higher credit scores and longer credit histories. VantageScore uses trended data, which provides a broader view of the credit profile and is typically used to score individuals with thin or minimal credit histories who may be overlooked by FICO models. The two scoring models are important because lenders get to choose which model to use. They also set minimum scores for approvals and the rates and terms that correspond with those scores. So knowing the differences between these two and how lenders use them is going to help you determine the best lender for your business. FICO and VantageScore both have different versions of their scoring models. These are indicated by the number that you see after the company name. For example, FICO 8 or FICO 9, or VantageScore 3.0 or 4.0. FICO and VantageScore both revise their credit scoring models every 5 or so years to keep up with changes in consumer behavior. The newest changes are the FICO 10 and the FICO 10T scoring models, which were introduced in 2020, but are just now being adopted by lenders. There are lenders that will be required to use these models. These are mortgage lenders regulated by the Federal Housing Finance Agency, or the FHFA, which are Fannie Mae and Freddie Mac loans, and this is going to begin happening in 2025. Any lender can choose to use these new models, though, and we're starting to see some adoption, which is only going to increase as time goes on. The FICO 10T scoring model in particular is really making headlines right now because of the impact that it will have on credit scores. The T stands for trended data, which means that this new scoring model will look at credit history over the last 24 months or more, similar to the Vantage score models. FICO estimates that about 110 million people will see a change to their credit score using this new FICO 10T model. About 40 million will see an estimated 20-point increase, while roughly the same amount will see a 20-point drop. As Andrew pointed out, FICO has a higher threshold for its scoring tiers, and a drop of 20 points could put a homeowner into a different scoring category, which could impact their chances for approval. The people who are going to be impacted the most by this are people that show risky lending behavior. To demonstrate this, I'm going to use an example of an average American named Tom. Tom is a middle-aged guy. He has a wife and 2 kids, and he works a decent paying job, but he supports his entire family. Tom is unable to make any headway paying down his credit card debt, so he takes out a personal loan to consolidate the debt. Their budget is already really tight when his wife begins having medical issues, and his credit card's balances begin going up again. Tom was also late on a couple of payments while he was struggling to get caught up. The new loan, increased credit balances, and the late payments have all had a negative impact on Tom's credit. Tom is now viewed as a risky borrower, and his credit score will decrease. While he may have qualified for a loan with a prime lender before, he now may be lucky to be approved in the near prime range. Tom is like a lot of Americans. In June of 2024, a Bankrate survey found that half of credit card holders reported carrying balances from month to month. That's an increase from 44% in January and the highest that it's been since March of 2020. 60% of those people say that they've been carrying credit card debt for more than a year, and about 36% of people surveyed said that they have more credit card debt than they do emergency funds. Something to think about is that you really never know what is going on with someone's personal finances. To think about this, we're going to use the iceberg analogy. There's a small bit of ice above the surface of the water, but there's a much larger chunk below the surface of the water that's invisible to the naked eye. Some customers may be struggling financially and ask you for help using financing. Those are going to be the customers represented by the small piece of ice above the water. A much larger group of customers are having financial struggles that you can't see. They may have a nice house with a nice car in the driveway, but they're in a lot of debt and they may be struggling to pay for your services.
So, why does this all matter? Getting an approval is especially important now, as American consumers expect a payment option. That's because payment plans are pretty much everywhere these days. We use them to buy anything from phones, furniture, cars, whatever it may be. Buy now, pay later options exist for just about everything. People do see it as a way to increase their buying power. And beyond that, Americans just don't have the savings that they used to. Pandemic savings have dwindled, and because people aren't saving as much, everything costs more now, including the cost of homeownership, which is up 25% from 2020. And a Bankrate study found that 19% of people are taking on debt for home repairs. Many of them don't want to place those charges on a credit card when interest rates are approaching 30% or more in some cases. And here's the proof. You can see here that 55% of home improvement projects are financed one way or another. And 94% of people will complete a project with a contractor if they are approved for financing. If you aren't offering financing, you are losing business to those who are, especially with the rising cost of equipment with the A2L transition. Financing can have a pretty big impact on your business. According to FinTurf, businesses offering financing at the point of sale can see average conversion rates increase by as much as 30%. If people use financing and payments as a way to increase their spending power, they're typically going to spend more with you as well. Linux reports homeowners paying with cash spend 31% less and 26% less if the purchase is made with a credit card. But not all lenders are the same. There are two main types of lenders that you'll be working with that we'll talk about today. We'll start with the large banks. The top 5 HVAC manufacturers partner with these banks to provide you with lending solutions you can offer to homeowners. These types of lenders take more of a one-size-fits-all approach, using FICO scores and traditional standards for homeowner loan decisions. They're going to have higher eligibility requirements for contractors to use their services, and they typically service credit scores in the prime and super prime categories. That's great for homeowners with good credit profiles, but it may result in a decline for anyone below those top tier credit scores. Thinking back to what Kelsi told us about the FICO 10T credit score change, this could qualify some homeowners, but could leave others without any options. If a homeowner can't get a loan approval, you could lose the job to someone who can get them funded. If you only have this option, you should look for a supplemental lender who can approve homeowners with credit profiles in some of those lower tiers. And let's go back to Tom Homeowner, the example Kelsi talked about earlier. Since this is a large bank and they typically use FICO scoring models, we're going to give Tom the average FICO score in the US, which is 717, which is in the near prime scoring tier. As we mentioned earlier, Tom's risky borrowing behavior causes his score to drop 20 points on the new FICO 10T scoring model, which reduces it down to 697. We know the FICO scoring tiers are a bit more restrictive, so this puts Tom in the lower end of the near prime tier on the FICO scale, and his application has declined. If you're only using a big bank lender, you may lose this job to a company who can get them funded. This is why it's so important to have a supplemental lending partner who can provide second look financing to make sure all your homeowners are covered. And Tom is not an extreme or really even unusual situation. The Federal Reserve frequently surveys senior loan officers at banks across the country. And earlier this year, those loan officers said their banks are tightening their underwriting standards. Optimus Financing reported approvals from prime lenders dropped from 70% down to 65%, which is leaving 35% of homeowners without a lending solution if a prime lender is the only option.
So here's a quick pro and con list for large banks. Pros. Great for low-risk homeowners with high credit scores. Manufacturers usually have promotions or discounts. Cons. They have stricter contractor eligibility requirements. You're just a number with the large banks, so they lack that personalized experience and support. Overall, large banks are going to be better for larger companies and homeowners with good credit. The second type of financing available as a lending partner falls into the category of specialty finance. It's defined as non-bank lenders that target borrowers that are not served by traditional banks. These lenders focus on specific industries, like the HVAC and home improvement industry. FTL Finance is a specialty lender. Specialty lenders can further specialize their services by focusing on certain credit ranges. So you could have a home improvement lender who specializes in subprime or deep subprime credit scores. Some may use traditional scoring models, while others may look beyond credit scores and consider rent, utilities, or other regular payments to determine whether a loan application is approved. This type of lender tends to provide a more personalized service to contractors and customers compared to the big banks because they're specialized and they work with smaller groups of people. When looking at specialty finance companies, it's important to understand what credit tiers they service. You wouldn't want to only have a large bank servicing prime and super prime credit as a supplemental lender who services deep subprime and ignore the groups of people in between. Some companies, and FTL Finance is one of them, use something called waterfall lending. This process allows us to serve a wide range of credit scores by taking one application and checking it against lenders one at a time to get the homeowner the best possible terms. This is how it works. The homeowner completes an application. That application goes to one lender, and if it's approved, it doesn't go any further. If the first lender declines the application, it is then sent to the next lender, and so on. This means that one credit inquiry on the homeowner's credit report and the best possible rates and terms for the homeowner. There is still a chance of a decline with waterfall lending, and at FTL Finance, we do have partners that can also service those homeowners to provide a solution. So let's check back with Tom homeowner. After Tom receives a decline from the large bank, you provide an application to FTL Finance, which is your second look lender. You don't know Tom's complete financial situation, but you feel confident that you can get him approved for financing because of our waterfall lending system. Tom submits his application and our underwriting team reviews it. We determine that Tom is approved for a loan with a near prime rates and terms. It's worth noting here that FTL Finance can be your only lending partner if the large bank options don't work for your business needs. We cover every credit tier, and your homeowner will receive the best possible rates and terms for their credit profile with us. So let's take a look at a quick pro and con list for specialty finance. Pros. These lenders provide individualized service for contractors and homeowners. And waterfall lending can provide a seamless experience for the homeowner. Cons. Because specialty finance is specialized, the scoring tiers for the lender that's servicing is going to vary unless they are like FTL Finance and use waterfall lending. Because of the many variables, you may need to do a little bit of additional research to find the right fit for your business. Let's do a quick recap. HVAC equipment and service prices are going up. Homeowners are looking for payment options for a variety of reasons. You need a lending partner to be competitive, and not all lenders are the same. Changes to credit scoring methods could impact whether homeowners are approved for financing, depending on the lender.
So, how do you know what lending partner is going to work best for your business? Your goal here is to provide loan options to a wide range of credit scores. This is going to maximize your chances of loan approval. You can do this by having multiple lenders that supplement each other, or by finding one lending partner that covers all credit scores. When choosing the best lending partner for your business, it's best to go back to basics. If you currently have a lending partner, create a pro and con list for that lender or lenders and use it as a guide as you evaluate new lending partners. As you shop around, consider how the lending partner will impact your business and the homeowners you work with. The goal for your business is to be an easy, supportive, and cost-effective option. When it comes to your business, you should be looking at the following areas. Registration requirements. This is going to be, what's required as on the contractor side. It might be years in business or annual revenue. There may be minimums there. Your cost to offer financing. This can include credit card and loan fees. In some cases, you may be paying both fees on the same loan. The type of work that are eligible for those loans. Some companies will only cover equipment, which may not be enough for some customers. So look for companies that cover service work in addition to generators, plumbing, electrical, if you do any of that type of work. Contractor support and training, as well as customer support. And of course, how and when you receive payment. FTL supports small and large contractors. Our registration requirements are right there on your screen. The owner's driver's license and a contractor license if required. Free distributor invoices showing recent equipment purchases, and then 2 distributor references. You'll also just need to complete some basic business information. In most cases, we can get you approved in as few as 3 days. And in most cases, you'll be paid directly into your bank account 24 to 48 hours after the job is complete. With FTL Finance, you do have ongoing support. You'll have an account success manager that'll help with your account setup and choosing the loan programs you want to offer. And they'll also provide ongoing sales support and training for your team to make sure you're comfortable offering financing to homeowners. You'd also be assigned a contractor support specialist who can help troubleshoot customer applications and provide administrative support and also some technical support. But next, we want to consider the impact on the homeowner. The goal here is similar to the goals for the business. Should be easy and supportive, and an experience with a high chance of success. Every business is going to be different, and you know your customers better than anyone. But here are a few good general areas to look at. You want an easy application process. So make sure the lender walks you through what that looks like. Put yourself in the homeowner's shoes. How long will it take them to complete the application and receive a decision? Ask about minimum and maximum loan amounts. Some customers may need a loan for a small amount to get them by to their next paycheck. You want to make sure that's an option. It's going to be just as important as those larger loans. Next, look at who can apply. If you provide service to mobile homes, for example, make sure the lender can provide loans for them. And like I mentioned earlier, if you offer additional services like electrical or plumbing, make sure the lender can offer loans to cover that equipment or service as well. Approval rates are another key factor, as well as how they handle declines, kind of like what we looked at earlier. And you'll also want to make sure the lenders offer customer support. And maybe most importantly in today's technology-driven world, do they have any digital tools to support their processes? FTL Finance has proprietary digital tools called Project Estimator and App Tracker. Project Estimator is a sales tool that allows the tech to input 3 different equipment and service options, along with loan terms and estimated payment for each of them. The estimates also act as a loan application for the homeowner, and if they have any questions, our customer service team is here to support them. Project Estimator integrates with App Tracker, which is another one of our tools. App Tracker keeps all of your FTL loan applications. You can monitor the status and reach out to the homeowner to schedule the job as soon as the loan is approved. Going back to the waterfall lending process we use, this keeps all applications in one system, where it is easy to track the loan status and when the loan funds will land in your bank account. You don't have to bounce back and forth between different lenders. FTL offers loan programs to fund everything in the home and even cover mobile homes for those without land ownership. Our programs cover both equipment and service.
Next, let's take a good hard look at your business and analyze the information. So here we want to break down how homeowners have paid for your service in the past. Calculate your payment fees. If you offer in-house financing, put a number to the amount of time it takes to secure those financing and collect those payments. What about delinquent loans or customers who default on their loan? How much money have you lost from customers who don't make their payments? Think about the cost of underwriting, billing, collections, and training to stay up to date on lending and debt collection regulations. If you make visits to the bank for deposits, put a dollar amount on that time. Think of any element of your business related to payment that has a cost or takes time and put a dollar amount to it. Use this to determine the actual cost of payments. FTL Finance has an 80% approval rate, and as we mentioned earlier, we can use that waterfall lending so that we service all credit score tiers. We offer loan programs with 0 fees for contractors. And if you want to offer same as cash or reduced rate options, we also provide those for a small fee as well. Once you've done the research on your own business and have vetted potential lenders at this time, it's time to review all of the information. Compare your pro and con list with potential lending partners' services. You want to conduct a cost analysis of potential lending partners compared to the cost of those services to use your current costs. It's hard to quantify convenience, but it's really important. So you want to consider what the techs are going through in the field and what would make their life easier. Also consider what would make your homeowner's life easier. The easier it is for the homeowner, the better the chance you have of winning the job. The easier it is for the techs, the more likely they are to suggest it to a homeowner. At this point, you should have enough information to have a clear answer. We've created a checklist to help you as you evaluate. For your business, make sure that you meet the registration and renewal requirements. Make sure registration and loan fees fit your business. There are fee loan options out there if you're interested that have absolutely no contractor fee. Make sure that you find a lending partner that offers these types of programs if that's what you're interested in. Find lenders that offer contractor support that goes far beyond just troubleshooting issues. Look for free sales training and assistance finding the right loan programs for your business. Getting loan funds into your account is also extremely important, so make sure that this process is easy and it fits into your business. Your homeowner checklist should be focused on providing the absolute best customer service. The lender that you choose should be able to provide an easy application process focused on getting the most number of customers approved as possible. This means that they should fund a wide range of credit scores. Consider a company that offers waterfall lending for this reason. Look for a lender that funds a wide range of project types and loan amounts as well. You never know when a homeowner may need help with a repair cost of a few $100s, but you also want to make sure that the homeowners that have higher price jobs can be funded as well. Do they provide customer support for homeowners applying and after the loan is approved? Let's do one final recap. HVAC equipment and system prices are going up. Changing credit scores are pushing more and more homeowners out of the prime lending category. If you only have a prime lending partner, you need to find a supplemental lender that can approve all of your jobs.
We know this is a lot of information, so if you have any questions at all or need help getting started, we're here for you. You can reach out to me directly. Thank you very much for your time today.
Thank you.